at 3,000, you might remember, at 53,000. And it's been long since then, and I'm starting to sell. This was a classroom from back then. We were buying into this bottom edge. Obviously, all the drawings are still there from the classroom we did. So we bought into this bottom edge at 50, at around about the 53,000. And you can see we had this massive arrival of volume when we were buyers. Massive, huge arrival of volume. That's crazy volume, right? It did retest the bottom edge here, so you'd had another chance to buy into it if you liked it. And of course, you had some additional opportunities to play, but obviously now we're starting to see this extension. And as I mentioned, I am now looking at this from a very, very suspect point of view here. And we've managed to make our monies. We love the monies, don't we? We love the monies. Everybody loves the monies. So, yep, time to go. Time to go. Time to chuck it in the bin. Let's see what happens next. We'll maybe try again some other time. One of the things we have seen today, interestingly enough, especially since bonds have been coming off a little bit recently, is we have actually seen a drop off in the 5 and the 2 year linkers markets. Might be as a result of that sale that we've seen on oil, but you can obviously see that this drop off in the linkers markets today, and in fact yesterday, is going to help us. But it might just be looking at this oil and saying, well, there's a bit more on that sell on oil, and therefore we're coming out a little bit of that linker play as well. So it's bringing down the neutral rate as far as I'm concerned, and that's obviously not a bad thing. Um, and obviously the takeaway from this, you can see obviously the curve starting to flatten out just a little bit as well in here, the 3 month, 6 month, and you can see the 2 year narrative as well coming in and starting to roll over, but still very, very steep. So the 3 month to 2 year, very, very steep indeed. But yeah, I mean, this is not a bad sign for inflation. That's good news. That's going to keep a lid on the concession phases, and that's obviously going to be therefore an opportunity to look at downticking bonds as possible buy plays when we start seeing the curve agreeing with that buy phase, and that's been where we've been challenged recently, as the belly of the curve has stayed very steep today. And I think if the belly stays very steep, I think you all know what we should be doing. We should be selling bonds, right? Well, the belly stayed very steep today. And because the belly's been very steep, it's been almost impossible to hold the long bond position beyond that 124.16. We've ended up a way down on the UB at 123 evens again. So that steepness on the belly giving us a headache, right? It's giving us a real headache, and we've just got to acknowledge it and wait for the next opportunity. So the next opportunity, of course, on the ZB is going to be 16 evens. That's where we were the last time, and that's where we'll be looking again this time, 116 evens, and that's going to be my target price for bidding for some bonds at the moment. So we're going to have to watch to see what happens down here at 16s. And obviously, that's important in terms of then looking, for example, at your vol surface. And, if you look at your vol surface, you know, everything, and I've mentioned this many times over, everything you do in treasuries is about the vol surface. Everything you do in equities is about the vol surface. Everything we do in oil and gold is about the vol surface. So when we're looking at the vol surface, um, we know that there's an acceleration towards 16s. So we don't want to trade 16 and a half. We already told you that. We showed you this chart earlier, didn't we? And we says we don't want to trade 16 and a half because we want to take that acceleration down to 16s and then look at this and try and hold the 16 bid. And if we can hold the 16 bid, then that gives us a real money opportunity to take a buy trade away from that price. And we have then looked at that in terms of the interest rate dealer keys. And if you look at the interest rate dealer keys and we start focusing on what's happening around the 116s price, we started to recognize quite a lot of volumes starting to creep into this as a bit of business here, didn't we? So when you look at the dealer's keys and you start thinking about what's happening down here, and you see that the volume actually dropped down to 15 and a half here. Do you see it? So it was originally at 16s. You can see obviously it went from 2,000 contracts here. 16 became under pressure, dropped down to 15 and a half. And obviously, if we're going to see this, if we see this volume coming back in at 16s, then of course you know that 16s is going to become a very strong bid. It's like watching a horse. If you look at the horse odds, and the horse odds go from 4 to 1, and then they drop to 6 to 1, for example, and somebody comes in and puts a 10 grand on a horse at 6 to 1, the bookies are going to drop it back down to 3 to 1 because somebody's taking advantage of that price, and therefore it becomes very bullish at that price. It doesn't mean it's going to win at 3 to 1, but it's certainly value at 6 to 1. So obviously, if we see that change taking place, I always track this. I do it in horses, and I do it on my markets here. You can see what happened here. You see that this used to have the big sell volume at 18s, and then what happened? Volume dropped to 17 and a half. This used to have the volume here at 16s. What happened? The volume dropped to 15 and a half. In other words, as the offer price drops, the bid price drops. As the bid price rallies, the offer price rallies. It moves away. So it's a channel. It forms this channel. We've covered this many times. We looked at it in terms of the bid offer spreads when we were looking at individual candles on a 1 minute chart. And now we're looking at it from a daily perspective here of just watching the movements. And if you pull away from a higher price and you move to a lower price, it's telling you the direction. It's telling you the direction. You understand that? So it doesn't matter what you're doing. It's telling you where the price is going to go next, according to how this is spreading out, right? So when you look at, for example, something like your energy markets and you look at oil, you can see how the change is taking place when the volume shifts in terms of where it's at, right? So when you see the volume shifting down or the volume shifting up, it's telling you, right? It's telling you. So when you see the volume coming away from these areas here and it's shifting down into these areas here, do you see how it's shifting there? Well, it's gone from 68s, 69s down to 67s. Well, that told you over the last 3 days that oil was likely to sell off a little bit. Oil has sold off a little bit, surprisingly enough. So none of this is surprising, guys. None of this is surprising. And who did you think had the Nasdaq sell off there, Jerry? Who do you think? Who do you think had the Nasdaq sell off? The dealers, surprisingly enough. Let's take a look. Can anybody see the dealers getting that sell off before it happened? So we'd already highlighted the 1550 buy reversal in the previous conversation. And we highlighted this last little bit of action in here. Yeah. So this was at 1515. So there's the pin rejection candle there. There's the candle we've got the black arrow at. And there was a candle that was forming that we were expecting to be a buy reversal. It turned out to be a buy reversal, but it was kind of crap. So obviously into the bottom edge, we can see a buyer comes in here. So there's a buy level. So we don't quite tap it. There's a buy trade there because it's obviously the opposite to the candle. There's a buy trade there because it's opposite the candle. Well, if it's opposite the candle, and it's at a higher price, that's good news because that's dead obvious. It's only when it's at a new high price we've got to be careful, or a new low price. Well, it wasn't at a new low price, but we see this candle opposite here. So that's one that we've got to be careful with because it's at a new high price. We don't know how far this is going to go through. When you get confident about the dealer's book, you start recognizing that that is still a crazy, crazy opportunity to sell into this. So what you're going to now do is you're going to now see the seller coming in here. And obviously, at that stage, if you're being very cautious, what you're now going to do is draw a line against that level and you're going to start thinking about selling the retest, assuming the value is still in place. So obviously, if we then sell the retest when the value is still in place, you can see that the sell we've had on the Nasdaq has been spectacular, absolutely spectacular, right? So we can obviously see and understand this as a process. It's a it's a process that if we can understand, it's a process we can obviously make a lot of money as on. But again, it is very much the case of just being able to recognize it. Sometimes it's just purely fair value. We don't have an opportunity. And other times it has crazy good opportunities like this one. And to take a cheeky little sell into that, you might have avoided some of these other ones. It doesn't matter. That was a very strong sell. And the takeaway from that sell was pretty good. If you'd taken that sell, it was at 1535. At 1535, this was a sell in this retest here at 135, and obviously the low price was down here at 85 approximately. So you're looking at a trade there that's about 50 points wide. That's $1,000 in 4 minutes. $1,000 in 4 minutes. How many of those trades a day do you need to justify your explosion in terms of your account size? You don't really need many of them. You just need one or two of those a day, don't you? You probably get a lot more than one or two of those clean value opportunities.